Dollar-rand exchange rate, this has certainly been quite a roller coaster ride from, 13.13 to 13.63, back down to 13.40 levels, and now at 13.19. It's been quite a volatile week for our local currency against the US dollar, again driven by a lot of internal factors like the outcomes of the ANC policy conference, the 14-point plan that we had from Finance Minister Malusi Gigaba, and of course the international influences like the US Federal Reserve and their stance on interest rates. That will also be influenced by some economic data expected out today. But to give us an analysis on this and how we need to react as investors is Carl Burgess, Portfolio Manager at Nedbank Private Wealth. Always good to have you, Carl.
Good to see you, Guga.
Likewise. Let's start off with the market activity, especially the currency and the international factors that I alluded to just a moment ago. It's been quite heavy from the Fed, and I understand we're expecting some inflation numbers from the US today.
Yeah, incredibly volatile week, as you mentioned earlier. 13.60, I think, was the high that we hit this week, and then down to 13.16, and back to 13.20. So really driving a lot of the returns on the markets, and it's kind of been the story for a long time now. But yeah, very busy week on the sort of economic front and political front. A lot of news coming out. Finance Minister presenting his 14-point plan, but then also internationally, Janet Yellen sitting in front of Congress and just reiterating the fact that they would probably look to, well, cool down on increasing interest rates if inflation isn't above the 2% mark, which of course it's not. So it hit 1.9% last month, if I'm not mistaken.
Okay.
But forecasts are that we're looking at about 1.7, 1.8%, and that data is going to be released later this afternoon, I think 2:30.
As an emerging market economy, though, would we want that inflation number to stay below that 2% so that the interest rates actually don't go up higher, then our bond yields continue to perform?
Yeah, I think so. It certainly would drive a more of a risk-taking sort of environment, which would obviously benefit us. We see the rand strengthening a bit more, and then of course retailers would probably run financials, which is something that we've seen today. You know, it would be quite nice to see some returns in that. We see a bit of value in both of those sectors, so it would be nice, I think, from an emerging market perspective. Long term and the whole effects on QE, that's a different argument. But yeah, as an investor in the JSE right now, I'd be hoping for that.
You mentioned value, and that's already got my ears ticking over, because we want to see opportunities to buy into the dips as investors. Looking at the likes of Woolies, also in positive territory today, over 1%. When it comes to the retail environment, and we saw the trading statement that they published yesterday, expecting headline earnings to be a bit weaker, between 5 and 10%. Again, are we significantly concerned about Woolies as a defensive play?
So I don't think it has the same sort of story that it did maybe 18 months ago, where we were looking for decent growth. I think the Australian acquisition of David Jones, that hasn't really worked out as sort of planned. If you look at the South African environment, it's you know, we're in negative growth territory at the moment, very difficult environment, and that's really coming through their results. So I don't think the market was quite expecting between 5 and 10% a decrease, so a bit worse than expected. But the stock trading higher today in the back of just sort of a strong sector. But if you have to have a look at it, I think it's certainly time to maybe readjust your expectations in terms of the retailers. Maybe instead of having a 1 or 2 year sort of outlook in terms of your returns, maybe it's time to really go and look 3 to 5 years out. Is this story going to resolve itself?
Sure.
You know, where value can be unlocked in the Australian market and David Jones, how food sort of from the Woolies side impacts the Australian business. Clothing in South Africa has been pretty soft. Food's been quite good in comparison, but there's only so much information we can really glean from a trading statement. So when their results come out in a couple of weeks' time, that's going to be very interesting.
So for the moment, better to stick to the multinational retail players, the Spars, the Woolies.
Yeah, certainly. I like Spar, I like Woolies, and I think some of the clothing retailers, they look attractive, but the environment is obviously quite tough. So you know, you could make an argument for both ways.
Let's touch on mining stocks, and Kumba Iron Ore also out with the trading statement. Interesting dynamics at play here with regard to the iron ore price.
Yeah, so it's been a bit of a tricky week. You know, we've spoken about it before. There's been quite a lot of volatility in the iron ore price. This week, I think we saw a bit of about a 4% uptick, and that was really just on the back of import numbers that into China were up 16%, if I'm not mistaken. But if you look at it a bit deeper, the inventory, port inventory levels on iron ore were up 4 million tons, so it's not really getting through sort of to where it needs to be. So it just shows you the kind of the issues that they are dealing with in terms of that price. But you know, at the beginning of 2016, January 2016, Kumba was trading at 26 Rand a share. It's now 170 Rand a share. I know that HEPS or EPS numbers, you know, between 46 and 58% is fantastic, but you know, essentially you need that and more to justify a 170 Rand share price, you know, going forward. So it's not a sector I'm feeling particularly comfortable with at the moment.
Would you say the same about gold? We've obviously seen some interesting dynamics regarding local pressures in the mining fraternity, and the gold price also coming under slight pressure right now.
Yeah, it's a difficult one because you tend to want to avoid a single commodity miner in South Africa. But maybe if you were going to look at the gold price as an investment, maybe look at pure gold as an ETF, or find some way to invest in it like that, as opposed to taking on additional risk of having the issues that we have in South Africa with the gold miners.
It's a little bit too complicated when there's too many moving parts to call on.
Yeah.
Another entity that gave us an update with regard to their relationship with the South African Reserve Bank, as well as the Public Protector's report regarding Bancorp, is ABSA, or Barclays Africa, out with that update. The share price, though, responding quite positively, and it seems as though market participants not reading too much into the politics unfolding in the background.
Yeah, so I think the Public Protector's report, if you have a look at it, there's been vast corners that have kind of rejected it. So it's not, I don't think I'm surprised to see the bank coming out with this stance. And I think it's, it's fair probably to have a look at all the facts. And, it's a huge sum of money that we're looking at the end of the day as well. And I'd, certainly probably do the same if I was in their position. But, yeah, again, we need to look at it on the back of the fact that, the banks are doing very well today. So, that's also probably just priced into it.
With that said, though, can we kind of expect the rally in the banks and the financial stocks to continue, or is that again another play with regard to the dollar-rand exchange rate?
Yeah, absolutely, and I think that a lot hangs off this afternoon. So I think a lot of market participants watching those inflation numbers this afternoon, and it's really been the story of the last 3 years that the currency and politics and issues have been driving returns on the JSE, because we're not really seeing those growth numbers coming through. So banks, retailers, we certainly need a better environment to see them really doing well. But certainly for the next couple of months, we're going to see the rand-dollar exchange rate really being the driver of those returns.
Richemont is also one of those famous industrial stocks, either around the 100 Rand level or dipped slightly below. Today, the announcement of one of its leaders leaving, I understand the head of the watch division, looking at other opportunities. But the share price actually not reacting to the news today, still at 108 Rand a share. Yeah,
so I think a lot of guys would be really happy that they've held the likes of Naspers and Richemont in their portfolios over the last 3 years. Otherwise, they certainly would be going backwards. But yeah, as you mentioned, the head of the watchmaking division resigning. Big businesses like this generally have really good contingency plans for issues like this, and I don't think it would be, in their lives a massive loss, and they'd certainly cover it with someone.
We've touched on many sectors and stocks that you actually like, whether they be in banking and financial services or even some of the retail counters. Which particular sectors would you steer clear of for the next 6 months of the year?
I think SA Inc. stocks I'd steer clear of, just because of the pure volatility in it. I'd prefer to be positioned in rand hedge counters. It gives me a bit more comfort, I think. So it's as I mentioned, I'd be avoiding SA Inc. stocks until December anyway. And certainly, I might even be avoiding the market, really, if you have a look at it. And,
really? Yeah, over the last 3 years, it hasn't done much, right?
Yeah, absolutely. I don't think there's anything, there's anything wrong with having excessive cash on your portfolio at this stage. What would the
appropriate portion be, percentage-wise?
I think it depends every client, but a healthy 10-15% in cash is not an issue, I don't think.
Sure, 10-15%. Interesting dynamics to play. And what about offshore? Because we've obviously seen quite a pickup as well in a lot of the FANG stocks and tech stocks in the US.
Yeah. So again, this is, if you'd taken cash out 2-3 years ago, certainly the right call, because you need to have some offshore exposure. But if you've taken it out and you're sitting at 13.75, and that was your exchange rate that you took it out at, at 12.65, a couple of weeks ago, you're going to be quite worried about that. So on the back of that, returns in the FANG stocks have been fantastic. But if you're sitting in cash, you're probably going backwards. You've got inflation in South Africa that's 7.5-8%. It's not an ideal situation to be in. So if you're taking cash offshore, I think, again, you need to just adjust your expectations in terms of returns, because they are going to be pretty slim. If you're sitting in cash, they're going to be negative. And again, this market is quite strange, that you've got huge momentum within, the tech sector at the moment, which is great. If you're in the tech sector, fantastic. If you're not in the tech sector, it'd be okay if you're in healthcare, which seems to do well when the tech sector comes off. But you really need to kind of pick your stocks and your sectors very well.
Sure. Interesting environment at the moment. Hey, lower volumes, not too sure how to react, and not wanting to miss out on particular
rallies.
Well,
that's the other thing. I mean, when there are such lower volumes, all these moves are exacerbated, which makes it even harder. So it feels like your normal sort of market economics not really kind of at play for the moment anyway.
You have an interesting job, Carl. Goodness.
Stressful, interesting. Yeah.
Exactly. Thanks for your time as always, Carl. A pleasure speaking to you. That was Carl Burgess, Portfolio Manager at Nedbank Private Wealth, giving us an update on the global market dynamics and how we as investors should be looking for value and reacting to the dynamics.